everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, welcome to our latest market update and outlook. The title of this video is Another Cut Bites the Dust. And so we're going to be talking about the Fed, which is what we're alluding to here, and a little queen. And we're going to be talking about some of the conditions that might keep this bull market running and how we're doing with those conditions. And then I'm also going to talk about one thing that is maybe being a catalyst to the market, even though maybe the economy is starting to show some signs of slowing down. What is that catalyst? Let's get right into it. All right, let's get started with the asset class returns for the month of February. So when we look at the blue here, you can see this is for the month of February. The green is for year to date. And overall, the blue is up. So that's a great sign. The month of February was actually a really great month, especially for large cap, in particular large cap tech stocks. So you can see the S&P 500 represented here by large cap was up over 5%. A really great month. Small caps were up as well. They're still down a little bit for the year, but had a nice recovery this month, as well as real estate. With interest rates going up a little bit, which we'll talk more about, real estate took a little hit initially in January, but starting to make a little comeback here, as you can see year to date. International did pretty well. Again, not as well as large cap domestic, but still doing pretty well overall, especially emerging markets. Fixed income was down a little bit, and that's, again, because yields went up. We're going to talk a little bit more about that. High yield was flat. They have a little bit more correlation with stocks, so stocks doing as well. It didn't go down as much. But interestingly, you see commodities were down for the month, but still up a little bit year to date. Oil has been kind of going up a little bit, but you have some metals and some other things that have been going down. So overall, pretty darn good month. All right, we can't have an update without talking about what's going on with the Fed. And the Fed did another pause. And so that's where we get the title, Another Cut Bites the Dust. Get it? For you Queen fans. Anyways, they had another pause, so no cuts. And they keep pushing back on the idea. Every time a Fed governor gets on CNBC or on the news, they talk about how they're not looking at cutting rates anytime soon. The economy is still showing pretty decent numbers. It is slowing down, but it's still showing up okay. And everything is kind of going the way the Fed wants it to go, but not quickly enough for them to feel comfortable with cutting rates. So you would think the market would have not liked that, but it kind of hung in there. So there may be something else that's going on, which we're going to talk about more here in a sec. All right, and then the latest for inflation. Again, this has been the driver for a lot of the markets here in the last year or so. And the favorite indicator for the Fed, when they talk about inflation, they're not talking about the CPI. They're actually talking about the PCE, which is the Personal Consumption Index. And in that indicator, they actually showed that the month-over-month number for the previous month, which is actually going back to January, was up 0.3%. Now, again, you annualize that, that's actually like 3.6%. So that's a little bit still on the high side. The Fed wants to get it to 2. So you'd think, again, that the market wouldn't have liked that. But the good news is that the year-over-year number has got a 2 handle at 2.4% year over year. So again, the market kind of took that in stride. They were kind of expecting it to go up just a little bit, but still having the year-over-year number come down gave people a little relief that the trend is still their friend in inflation coming down. So it begs the question, we had 2 big data points that weren't really great news for the market, but we saw a really nice move in the market in February. Well, frankly, I think it surprised a lot of people, and I think one of the main drivers is this thought of AI promises. All right, AI being artificial intelligence. and I'm sure you've seen a lot of this in the news, but essentially AI is promising businesses to become a ton more productive, a lot more productive. And if this actually comes true, there could be more room to go for companies and businesses to expand. Right now, we're mostly seeing it in the large companies. They're the ones that are really investing in it. But once the smaller companies could actually start using this AI and implementing it in their business practices and becoming more productive, that's where it could really accelerate, and just that probability is what's getting the market kind of excited. So I think a lot of what you saw this month wasn't so much from those fundamentals, but these AI promises. We'll see. All right, in January, I talked about the 6 things that could keep this bull market running. And so what I wanted to do today is I wanted to take a look at how we're doing today or now versus where we were in January. And remember, we've had the market have a nice run up since January already. So let's start with what's going on with the potential Fed rate cuts. Now, the market was anticipating at the beginning of the year about 6 rate cuts. Now, this is a chart that shows the probability of where we're going to be at the end of the year. And at the end of the year, the market has the highest probability right now at somewhere around 4.5 to 4.75. And today, we're at 5.25 to 5.5. So if you look at each rate cut being 0.25, that's how this works. That's really only 3 rate cuts. And so the market is actually only pricing in 3 rate cuts now instead of 6. And the Fed rate cuts is what helps the economy kind of start moving a little quicker again because of all the weight of high interest rates. So you would think that this would be a negative for the market, but yet the market's up. So interesting. Okay, now condition number 2 was no economic slowdown. And when you look at how the economy is doing, it does seem to be slowing down. We did have a couple of the big reports that came out over the last week that show manufacturing and services are both slowing down, but still hanging in there. And when we evaluated this back in January, I showed you this chart that shows the price to earnings ratio and what was being priced into the stock market. How much good stuff was being priced into the stock market. And so what we're showing here is that back in January, the forward PE was 19.5 times, which is a little on the high side, okay? The average is usually somewhere around 16, 17. So we're on the high side. But now we're actually at 20.4. So it's gone up even higher. Again, is it because of AI? Well, it's definitely not because of what the Fed's done. So I think that has a lot to do with that. All right, condition number 3 was that we continue to have solid earnings growth. Now, back in January, the expected 2024 earnings growth was for 11%. You can see that's basically the difference between 2023 and what we're going to see in 2024. And that's about an 11% earnings growth. And this is basically the same today. So earnings growth projections didn't go higher. They basically stayed the same. And so you could argue, again, that's not super wonderful, especially after the market had the run-up that it did in February. All right, condition number 4 was that we continue to have no big geopolitical flare-ups. And one could argue that things have not gotten better, especially with the situation with Hamas and Israel. It's actually gotten a little bit worse now that we have the Houthis over in Yemen causing all kinds of trouble. So what we're seeing here is you're actually seeing oil prices since the beginning of the year. They were at about 72 or so. As of the end of the month, we were right around 78. It's actually a little bit higher than that as of this recording. So you can see that the tension is building up a little bit. And you could argue that maybe the economy is doing a little better than people thought. That also has a little contributing factor, but it's also those geopolitical issues. They don't seem to be going away. All right, and then the last condition to continue to have the bull market going is no political chaos. Now, we still have a ways to go till November. Still a lot of things can happen. There's a lot of anxiety about elections and how they're going to be interpreted, if they're going to be rigged, and all this mess. And so hopefully it won't come to that. But you're starting to see a little bit of that political instability build into the 10-year Treasury rates. At the beginning of the year, we were actually under 4%, and we've seen rates kind of creep up a little over 4% now. They actually hit to about 4.3, and so they've been coming down a little bit, so that's good to see. But still, you see rates going up. And so we want rates to stabilize right around this 3.75 to 4.25 range for things, I think, to be okay for the stock market. All right, so what does this all mean? As you can see, things seem to be getting a little bit worse as far as those 5 conditions for the bull market to continue, but the bull market continues. That's the irony of the stock market sometimes. And sometimes you just can't fight it. You gotta roll with it a little bit. But as you can see, I'm getting a little bit more hesitant on how long I want to roll with it. And we're going to continue to stay on this neutral path, though it's been working very nicely for us. We're starting to trim a little bit of that high tech that's done so great in the last 5 to 6 months, adding a little bit more to real estate, adding to more income-oriented equity so that we can get a little bit of protection in case we see a little pullback in the stock market. I don't expect anything big, but a 5% pullback in the stock market is pretty normal. We normally see that around 2 to 3 times a year, and so we might be due here. And I'm going to continue to add to bonds from cash, locking in those quality bonds, the little longer maturities with the nice juicy yields that we're getting. Cash is great. I don't mind having some cash, but I do feel as the Fed starts to contemplate and get closer to cutting those rates, those yields will start coming down. And you don't want to wait till the yields are already lower before you start buying the bonds. You want to lock those in. And so that's what we're doing as well with the bond market. So I hope this was helpful, guys. If you have any questions, please feel free to reach out. Please feel free to share these videos. And thank you very much, and God bless. Bye-bye.